Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into your U.S. trading day. Let's get you the three catalysts for watching this hour. First up, U.S. stocks continue to decline as tech stocks drag the market lower. We're going to break down the market outlook as volatility looms over Wall Street. And we'll sit down with the CEO of ride-sharing company Lyft as they announce a $200 million expansion into Europe. Plus, trade talk hopes boosting oil prices today. We'll break down the demand picture for the commodities market as investors race for slowing growth amid the trade war. Half an hour into the start of U.S. trading, let's take a look at the major averages here. Starting out with a lot of selling going on. You've got your S&P 500 off about 1.5%, but no surprise to see the tech sector taking it on the chin here for the broader market. You've got your tech-heavy NASDAQ down just about 2% here. Interesting to look at what's pushing down the S&P 500. Communication services, that includes Tesla and IT technology, the biggest laggards in the S&P 500 at the moment. But let's flip it over to the bond market here, which has been calming down just a bit, but you can see yields picking up just a touch today. You've got your 10-year up about a basis point and your 30-year yield up about 2 basis points at the moment. Finally, let's take a look over at Bitcoin, and we are seeing that risk-off sentiment hitting Bitcoin this morning as well, off about 2% at the moment. I want to bring in Steve Sosnick. He's the chief strategist at Interactive Brokers with over 40 years of experience in the business. Steve has held senior trading roles at Morgan Stanley, Lehman Brothers, and more. He joins me for the hour. I also have to say personally, one of, if not my favorite source to talk to on the street, because you never make me feel like I don't understand things, Steve. You break down everything in such an engaging and digestible way. So true treat for our viewers. But I want to start by talking about what we've seen in volatility, hitting a record on the VIX and then coming in just a bit. How are you thinking about the path forward for volatility and just this market amid all of these swings?
Well, thank you for that introduction, Maddie. I couldn't ask for anything better. But the VIX here telling us, staying above 30, it's interesting because we sort of calmed down the last couple of days, and yet VIX was way off its highs. It's really a glass half empty, glass half full thing. Mm-hmm. If you want to say, well, look, VIX is way off its highs. Yeah, it was above 60, and now it was around 30. Mm-hmm. On the flip side, 30 has always been a number that people have said tells you that the market's really disoriented and pricing in a lot of volatility. There's a lot of uncertainty out there. And another thing to keep in mind is here's a little option trading trick, is if you take a number, when you see volatility numbers, they're usually annualized. Well, annualized doesn't really mean much, especially in the case of the VIX, which is meant to be a 30-day look ahead. Mm-hmm. So how do you translate that into something that makes sense? I'll spare you the mathematics, but just divide that by 16, which is the square root of business days in a year. Mm-hmm. And so 32 divided by 16 is 2%. That is what the market is telling you they expect for intraday moves over the coming 30 days. Considering what we've seen, that doesn't seem unreasonable. Considering what we're looking at now, that doesn't seem unreasonable. Remember, it's high to low. It's not close to close.
Is the market acting too calm in your view? I wonder about how the market, when they get an initial shock of news, like the April 2nd tariffs announced, huge sell-off, but then any additional news after that, there's some moves, but nothing too dramatic. Are we bad at pricing in any new tariff risks just because of how big the initial shock was?
Well, I think it's almost, whatever doesn't kill you makes you stronger. So I think if you've been exposed to whatever they're saying on tariffs is not going to be as market jarring as what we learned on April 2nd. Mm-hmm. So anything we learn now is incremental. So the incremental is going to always be a little bit less than that big initial shock. And so we're working through that. On the other hand, it's not the best analogy, but it's almost like aftershocks after an earthquake. They're not pleasant either, but they're never they're rarely as damaging as the first one. But on the other hand, if the system's already a little fragile, they can have their own damaging effects.
And part of the problem was that we were already seeing an unwind even in some of the big tech names before those tariffs were even announced. How are you thinking about the path forward for big tech, especially with some of the NVIDIA news, the chips news today?
This NVIDIA news is kind of jarring because, someone asked me this morning, is this related to the tariffs? And I have to say yes, because the whole point of the tariffs was to bring manufacturing back to the U.S. Mm-hmm. Well, how long ago did NVIDIA announce that they were committing $500 billion to increasing manufacturing in the US? What was it, yesterday? And today we learned that, oh, by the way, you can't really use some of the chips that presumably they were planning to export as part of the $500 billion investment.
Yeah.
This is uncertainty, and the uncertainty is a killer for a company, for any company. And you heard United Airlines, I thought, handled it brilliantly by saying, okay, here's guidance A, here's guidance B. But uncertainty is reflected in volatility, and this is what we're living through right now. So the NVIDIA news is very jarring, and it, in many ways, it's emblematic of the difficulty that companies have in making long-term investment plans. You know, even though that's really the goal of the whole tariff situation.
So what are you seeing in terms of investor activity amid that uncertainty? I know you get a lot of insight into client flows, and among, if not the most bought name recently has been NVIDIA. Does that tell you that dip buying is still alive and well, and should it be alive and well?
Dip buying has been alive and well the entire time. The question is, are you buying? You know, and it's a historically good strategy. I'm sure, like in the markets in like Mesopotamia somewhere, someone told their friends buy the dip in wheat future, in wheat contracts, whatever. But so this has been going. It does make sense. But the question is, are you doing it mechanically? Just this stock is lower, I'm going to buy it. And NVIDIA certainly, that's one of those stocks that people, brought people to the dance, so to speak. A lot of people made a lot of money investing in NVIDIA and are quite loyal to it.
Yeah.
It's understandable. But are you buying it just reflexively, or are you buying it because you see value? There's a big difference, and I think a lot of people have switched into reflexive mode. We saw customers buying the dip the whole way down, which did work for them. For those who bought on that week ago Monday when things were awful. On the other hand, they were buying the whole way down before that. So I can't tell you how it's working out individually for customers one way or the other, but they've been very loyal to their favorite names, NVIDIA, Tesla, and they've been levering up. They like the double levered ETFs on those names. They like QQQ, which is the ETF that tracks the NASDAQ 100, was less active than either TQQQ, which is 3x levered, or SQQQ, which is minus 3x levered.
Can we stick on that for a second? Because that has been fascinating to me, that people are like, oh, this is the time to get as risky as we can possibly be on our bets on the market.
A lot now. Our most active. We cater to active traders, and so when I look at these volume reports, I'm looking at the most active traders with their most active activity, and it's also skewed by order flow, not by volume. So a lot of so they're going to be in and out very quickly on a lot of these triple levered ETFs. But there are people who run from danger. There are people who run toward it, and I think we have a culture now where a lot of people have been rewarded by taking risk. From late 2022 through about a month ago, you were rewarded immensely. The more risk you took, the better you generally did, particularly if you were doing it in these big tech names. Now the paradigm has changed somewhat, but the risk tolerance has not necessarily changed so much. And I think people, yes, the normal response among a lot of investors is there's a lot of volatility. I'm going to pull back a little bit. There's certainly a subset of active traders who are like, there's a lot of volatility. That means opportunity. I'm going hard. I'm going hard. Yeah, that is definitely something that you are seeing, Steve, and a great overview of that activity. Thanks, you. You're going to stick with us for the whole hour. We are going to get to some more names. It's now time for some of today's trending tickers. We are watching NVIDIA, Apple, and Wall Street banks. First up, several Wall Street firms cutting their price targets on NVIDIA's stock after the chipmaker disclosed that it anticipates a $5.5 billion charge from new chip curbs. The U.S. government told NVIDIA earlier this month it would need a special license to export certain chips to China. Analysts at BofA Global Research, Piper Sandler, and Raymond James all lowering their price targets on the news. And also, Steve, what I also thought was really interesting here is an analyst over at Citi talking about how it's not just about NVIDIA. This could also impact Broadcom. This could also impact other chips names in the space. Well, you're seeing them sell off today. I mean, AMD announced an $800 million charge along in there. Broadcom was trading lower this morning as well. ASML was trading lower, although they released earnings, but they're all part and parcel of this. This is not good news for the chip sector because I don't mean to just sound like a broken record, but this is uncertainty, and uncertainty, the markets don't love uncertainty.
Well, speaking of uncertainty, let's get to another name we're looking at. Apple's main suppliers in India shipping roughly $2 billion worth of iPhones in March ahead of President Trump's reciprocal tariffs announcement. That is according to new customs data. Smartphones have since secured a temporary reprieve from tariffs, but persistent tensions between the U.S. and China threaten the iPhone maker's China-focused supply chain in the longer term. The Wall Street Journal reporting Apple is investigating moving some iPhone production to the U.S., but the process could take years. And CEO Tim Cook has said in the past that it would be difficult to find the skilled labor in America that's needed to build the smartphones. Treasury Secretary Scott Bessent dismissed that comment and concern in an interview with Yahoo Finance.
You don't need a PhD in mechanical engineering to assemble an iPhone. So I'm not sure why Tim Cook says that the skills aren't here.
And Steve, I think what analysts who cover Apple might say and investors might say is that skilled labor does take years to build up and is certainly something that allows Apple to turn out these iPhones incredibly quickly.
Well, that's it. I mean, every labor now is not just pounding a hammer and nail. There's intricacies in the supply chain. I know that the Commerce Secretary with this comment, we're going to have lots of people screwing tiny little screws into things. That's not what people really want. We want the high-tech value-added manufacturing because, quite frankly, our cost basis is higher. So if there's value-added stuff to be done, that's great. If it's just bringing low-skilled labor, bringing back low-skilled jobs, that's not necessarily, I understand the need for that, particularly maybe in some strategic industries. But overall, I think we want people bringing a skill set to it. I saw a statistic. This was posted on Twitter by my friend Frank Luntz, whom I trust. And he got the statistics from the Cato Institute. 80% of the people, when asked, said, do you want more manufacturing in the U.S.? 80% said yes. When asked, would you take a factory job? 75% said no. 23% said yes. The other two said, I already have a factory job. So it's one of these, it's nice in theory, but in practice, you need skill. The people who are going to take these jobs, by definition, are really going to be skilled labor, not just people, not just automatons screwing in screws.
Right. The price that they're requiring for their labor requires it to be skilled. All right. Finally, trading desks. Some of the biggest names in banking cashed in on market volatility in the most recent quarter, and that is not including the past 2 weeks, which fell outside of that reporting period. Morgan Stanley, JP Morgan, Goldman, all seeing record equity trading revenue during the quarter. Despite the blockbuster results, executives did express some caution about the current macro backdrop. JP Morgan's Jamie Dimon warning of considerable turbulence roiling the U.S. economy, while Goldman's David Solomon said the prospects of a recession had increased. You couldn't pay Solomon to mention the word tariffs, but he did maybe allude to it in that comment. Is this trading revenue for banks a signal of strength in your view, Steve, or is this something that can kind of hide any economic macro concerns?
Kind of the latter. I remember I spent the bulk of my career as an option trader, and I loved environments like this. And to Jamie Dimon's comment, about turbulence, I always describe VIX as sort of the price of a parachute when the plane hits turbulence at some level. People want that protection. But here's what happens during volatility if you're an active trader. You widen your spreads, you shrink your sizes. So effectively, that really impairs liquidity. But if you're the person trading off those bid-ask spreads, each trade you do is more profitable. And so, yes, that leads to the trading desk making more money. But really, analysts typically discount that over time. It's actually a little odd this quarter that the analysts are very happy that the banks are making all this money trading, because for years, again, as a trader at a publicly traded firm, the analysts were always very dismissive when we had a good quarter. Right,
because it's potentially not a sign of continued gains to come for the bank. Steve, thank you so much. You're going to stick with us. For our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, Lyft is expanding into Europe. CEO David Risher joining me next on what's next for the ride-hailing company. Stick around for that. You're watching Catalysts. Lyft entering the European market, buying taxi app FreeNow in a $200 million deal. The acquisition will allow Lyft to expand in more than 150 cities across 9 countries. Joining us now to discuss the news, David Risher. He is Lyft's CEO. David, thank you so much for coming in studio with us this morning. We appreciate it. Talk to me about this move. Why does this make sense now? I know you've been focused a little bit more domestically as of late.
Well, so that's it. So for the last couple of years, we've been very focused domestically, and we now have better service than we've ever had before. We pick people up faster than ever. We're profitable, we're generating cash, and so now's the time for us to go big and go global. We're actually doubling our market size, the addressable market, by going to Europe with FreeNow.
It's interesting that this is the moment to go global when we are in the middle of a, perhaps you could call it a global trade war with the United States and several other countries. How are you thinking about the impact of that as you think to expand? Are you going to use, Lyft branding in Europe? Are you going to stick with FreeNow? And how do you think about kind of the American image on a global stage right now?
Right. I mean, look, we're thinking long term, and I'm still, I'm betting on America long term, no question. Short term, we'll definitely be operating as 2 different brands. Nothing is going to change for riders or drivers. But FreeNow is a great product. It's actually a taxi-first product, which if you're in the U.S., you might think taxis and you have a certain sort of impression here in New York City. But globally, taxis are an incredibly important business. Think of black cabs in London. Think of a Mercedes in Germany taking you to the airport. That's kind of what we're trying to kind of connect with.
Speaking of airports, I do want to get a sense of what you're seeing on the consumer side of things. Have you seen any slowdown in airport travel?
Not significant. We look pretty closely at these things, and it is true, maybe a tiny bit of softness on the airport side, but that's frankly made up for by a little bit of strength actually on people just kind of going out during the weeks. So nothing significant for us. Lyft is, we do about 2 million rides a day, and drivers make, billions of dollars a year on it. It's really part of people's daily lives, not a discretionary thing that you might cut back on.
Okay, so talk to me about that. Where are you seeing evidence that this is part of someone's daily life, that it sounds like you're describing it as a recession-proof necessity versus something that people can scale back?
I think so. Look, people, again, it's just better to be driven around by somebody else, right? Think about it. You're in the back seat, you can text, you can take a nap, you can talk to the driver if you want to. So, and for a lot of people, rather than, parking and so on and so forth, it's just a better way to get around. So what we've seen is, and this, quarter after quarter, growth. We have more drivers on the platform than ever. We have more active riders on the platform than ever. So I don't know, recession-proof is a dangerous thing to say, you never know, but I would say we're, as I say, pretty baked into people's lives.
And talk to me about how you prevent folks in bigger cities that do have access to things like public transportation from utilizing that a little bit more. Obviously, I'm having my East Coast bias right now being based in New York City, but I have a lot of people in my life who've said, okay, we're worried about a recession. We're taking the subway even on a Saturday night.
Right. Well, I tell you what, so we operate bike systems across the United States as well, and it's interesting. We've actually seen some record highs in places like San Francisco, where the weather's a little nicer. Even here in New York, a couple weeks ago, there's a crazy warm day. So, maybe what we'll find is more people are biking and fewer people are taking rideshare. But again, it's the sort of thing that I think for most people, how they get around, going to the doctor, going to the dentist, going for a job interview, it's a pretty basic part of people's lives.
Another element of business news that I want to talk to you about is what we're seeing in terms of activist investors taking a stake in Lyft and looking to have those additional board seats. Talk to me about how you're thinking about interacting with those activist investors.
Sure. So we interact with investors all the time, of course, and take shareholder concerns super seriously. We've been in dialogue with these guys for a little bit, but I think really, we tend to look sort of long term and notice, again, we're profitable now. We're generating, $700 million of cash. Never been stronger financially, so we feel really good about our position. But there's a whole process to deal with the activists.
Are there, and I should mention Engine Capital as well. Are there any concerns that they've brought up that you feel are valid concerns, that are things that you're also worried about in terms of the company moving forward?
The types of things they're bringing up are things like, gosh, we'd like to see you, global. Gosh, here we are. We'd like to see you return capital to shareholders. Well, good news, we announced a $500 million share buyback at the end of last quarter. So I think we're actually pretty well aligned with the sorts of things that all of our shareholders are bringing up.
And to that end, I know you have cash on the balance sheet, obviously, to utilize for things like acquisitions. How are you thinking about pricing power in this moment where consumers may be a little bit more pressured? Are you thinking about doing anything to make rides a little bit cheaper? I know that's kind of been your competitive advantage already, but how do you think about that moving forward?
Yeah, so our pricing strategy is to be competitive and reliable. People really don't like all the surge pricing and stuff like that, and so we took out something like $40 million of surge pricing last year, sort of just to really make sure that prices are stable. In terms of the competitive dynamic, as I say, we tend to be competitive on price. We hope we're a little bit cheaper over time. We definitely hope we pick you up faster than the other guys, and we do, about 40 seconds faster than they do. But right now, I think we're actually priced pretty well.
There's another competitor in the room, Waymo, which, according to some reports, is a little bit cheaper in certain cities here. Bank of America did downgrade Lyft on Waymo's expansion. What is your pitch to consumers about going with Lyft versus an autonomous vehicle?
Well, I mean, so Lyft does maybe 2 million rides a day. Other companies like Waymo, which is a self-driving company, great company, but it's very, very small compared to that. So my big pitch is basically like, look, we're a great service. We'll pick you up fast. If you want to talk to the driver, if you want help with your luggage, if you want, the safety and sort of security that having somebody else in the car gives you, great. But self-driving is great as well.
Are you concerned about Waymo taking market share?
No. And I say that because look, all the self-driving companies have the same issue, which is that it's a very expensive technology. And so over time, what they're going to want to do is partner with organizations like ours. We have a partnership with May Mobility, for example, that launches in Atlanta later this year. We'll have other announcements coming over time, of course. So, look, there'll be competitive skirmishes for sure in different parts of the country maybe. But I think broadly speaking, what we've seen with self-driving cars is they actually expand the market. People come and say, this is a cool new product. I want to give it a try.
Getting used to kind of that ride share capability if they haven't
Exactly.
been exposed to it previously. I do want to end on a wonky part of the market that we've been really focused on, which is the currency headwinds that we're facing. We're seeing declines in the US dollar. Now that you are expanding internationally, how are you thinking about that? Is that a concern to you?
I mean, again, long term, I think, I've got a lot of faith in the US and the US currency. Free Now is a great company, but it's about $1 billion in bookings compared to our $16 billion in bookings. So in terms of actual exposure, it's quite small. And maybe it's not such a bad thing to be sort of, get a broader, basket of currencies. But again, I'm long US. Long
US, all right. Very good to hear as a US-based CEO. Real quick, I hear a rumor that you get around the city on the city bike.
I do.
Here. Is that true?
In fact, I biked here this morning.
Wow.
Yeah.
You couldn't tell by the crisp white shirt. I'm jealous that you're able to do the biking. I don't have that capability. You'll have to give me some of your tips and tricks, David.
I'll do it next time. It's great to talk to you, Madison.
Great to speak with you. Thank you for coming in studio. Really appreciate it. Thank you so much. On the bike, too, no less. All right, we're going to move on to autos here. The New York International Auto Show kicking off today as automakers deal with the fallout from President Trump's 25% tariffs on auto imports. Yahoo Finance's senior autos reporter Pras Subramanian is live from the floor of the New York International Auto Show with more. Pras, what do you got for us?
Hey, Maddie, 125 years ago, the first New York Auto Show opened its doors, and I think shortly thereafter that, they were talking about tariffs back then. So, time is a flat circle, and yet again, the topic du jour today, here in 2025, is tariffs. Automakers talking about how they can respond to it. Some of them telling me they're going by day to day, month to month, how they're going to respond via prices or incentives, things like that. Other automakers telling me that, if they get the exemption for auto parts, that might actually help a lot. It might actually make a big difference for them, and they could possibly live with the foreign export tariffs that Trump has put in place. But in the here and now, at this show right now, a few interesting cars we're going to see later today. So Subaru's Trail Seeker EV just got unveiled. Interesting little SUV there, but it's a full EV, right? Kia's EV4, another EV that we're going to see later. That's sort of adding to that portfolio of EVs that Kia has sort of successfully been selling here in the U.S. And finally, Hyundai with the Palisade, which is going to happen any minute now, an SUV that's very, very, very a big seller for them.
Hi, Pras. This is Steve Sosnick here. Having been to the auto show several times in the last few years, everything was moving toward EVs. You mentioned the Kia EV. Is that still a broad trend, or has there been some pullback to your knowledge about the love of EVs?
Oh, it sounds like we are going to have to leave it because Pras is having a little bit of issue with the sound because they are calling folks in to the auditorium there at the Javits Center. But our thanks to Pras Subramanian for joining us. We're going to have all your markets action ahead, so stick around here on Yahoo Finance for more. You're watching Catalysts. Oil prices are moving higher on potential trade talks between the U.S. and China, with Beijing saying they are open to speaking under certain conditions, according to reporting from Bloomberg. Crude prices have been under pressure since the announcement of President Trump's tariff plans, the International Energy Agency slashing its global demand growth forecast, saying the tariffs pose a, quote, substantial risk to the global economy. Joining us now, we have Catherine Porter-Watt, Logic Energy consultant. Catherine, Great to speak with you. So much going on at once that could impact the path forward for commodities. How are you finding clarity in this moment about where the price of oil is heading from here?
Well, that's quite a difficult question to answer. There's various competing pressures happening now on oil prices. Obviously, you've got recessionary fears that are driving prices down. You have fears of oversupply. You've got new supply coming on stream in the next year or so in Brazil, Guyana, and Norway, which is obviously going to soften prices. You've also just had a production increase from 8 of the OPEC plus countries, which makes the market go from what had been a fairly well-balanced market now to looking quite long. Now, we might expect OPEC to potentially cut prices to cut production to support prices, but perhaps not because of the internal dynamics within the group, and Saudi Arabia in particular wanting to punish people who've been cheating on their production targets.
Mm-hmm. And I had a conversation with a source earlier this week who said that there could be guarantees of direct purchases of LNG put into tariff negotiations between the U.S. and China. How are you thinking about that as a tool within the trade war?
Yeah, so that would be quite interesting. The whole trade war with China is going to have quite a significant impact on the energy spectrum for the US more broadly. It obviously doesn't just affect oil and gas producers, and clearly with oil prices where they are now, that's putting the profitability of the shale plays into question, and certainly making big questions around the prospects of new drilling, which is clearly a priority for the administration. But it also has a wider impact on renewable energy. That's obviously not such a priority for the Trump administration, but nevertheless, it makes all of the supply chains more expensive. So I think the energy sector more broadly would be pleased to see anything that looks as if it's going to be a softening of the somewhat hostile rhetoric that's been going on between the US and China.
And Catherine, Steve Stosnick here in studio with me as my guest host today. He's got a question for you.
Hi, Catherine.
Hi.
You know, you mentioned a bunch of factors, none of them bullish for oil prices. And literally, as I'm sitting here, I see that inventories rose 515,000 barrels to the highest level since, I guess, July. Is there a bullish sign on the horizon, or you know, are we just sort of looking at lower oil prices, which benefits consumers in the long run, but definitely does not tell a great picture for the economy potentially?
Yeah, I mean, I don't know whether in the long run it will be so great for consumers, because eventually you will get a correction as, you know, the length in the market will be taken away by producers who can't operate economically at these levels. I think really the answer to that question lies probably outside the energy markets and more into the wider scope of what's going to happen with this effective trade war between the US and China and how the US manages these relationships, obviously not just with China, but also with Europe. There's huge pressure for Europe to take more US gas in particular. And so it really depends on what Trump's strategy here is going to be, whether this is a long-term play for him to maintain tariffs and have this sort of very strong arm tactic around his economic policy, or whether this is more of a short-term play to try and get people to move more in line with his wider policy objectives. And that's really a very difficult one to call. If we continue on the current track, then yes, there's not really good news for oil prices in the near future. And that's going to be particularly bad news, actually, for the US shale market.
You know, the buzzword in the equity markets has been uncertainty, and it sounds like that's really the buzzword in the energy markets as well. How you know, considering that there's a longer time frame, you know, in terms of production, consumption, that sort of thing, how do you feel the market is best positioned to deal with that uncertainty? Do you feel that it's properly priced in right now?
No, I think it probably hasn't priced in. I mean, we obviously saw quite a significant drop in prices when these tariffs were announced. But interestingly, the energy pieces are not actually within the tariffs itself. So oil and gas and coal are largely excluded from the tariffs. So there's actually quite a bit of scope for things to get worse before they get better. Things like the internal conflict within OPEC and how much Saudi Arabia is willing to accept the pain of lower prices to try and force better compliance with the production targets within the group. So there's an awful lot of stuff that can move in a bearish sense here. And yeah, as you say, I think there's probably very little good news at the moment.
And Catherine, more of a geopolitical question here. I am just curious to get a sense of your thinking on how this trade war is impacting the relationship between U.S. allies and adversaries, and if there is a potential dynamic here where you could see U.S. previous allies and adversaries kind of teaming up and how that might impact the broader oil market?
That's kind of an interesting question. At the moment, I think the adversaries, primarily Europe, are not particularly feeling that friendly towards China. I don't know how much you've been looking at what's happening in the UK recently, but we've just had a rather significant scandal around one of our last remaining steel companies, which is Chinese owned. And the Chinese owners appear to have deliberately restricted the supply of coking coal to this plant in an effort to force a cold shutdown of the furnaces, which has been a very significant political issue here, and lots of conversations about the UK's relationship with China and how the UK wants to position itself in relation to both Europe and the US in this wider trade war.
Right.
Now, Europe's also looking at putting retaliatory tariffs against some of these US tariffs, but that doesn't necessarily mean that Europe's cozying up to China, and it's definitely not cozying up to Russia because of the ongoing conflict in Ukraine. So I don't really think at the moment we're seeing very much alignment between non-US and US countries within this whole wider spectrum.
Yeah, really important context there, Catherine, as people kind of project out these relationships happening that may not necessarily be happening yet. Catherine Porter, thank you so much. Appreciate it. Coming up, are changes in the bond market making municipal bonds more attractive? Before your eyes glaze over, this could be a good investment for you. Stick around for that next on Catalysts. Municipal bonds are coming off of their busiest trading week ever, with a record $6.9 billion traded in a single day. And with tariff-related volatility sending investors in search of safe havens, municipal bonds becoming the star of the show for a little bit here. I do want to bring in Dan Close. He is Nuveen's head of municipals. Dan, great to speak with you. Congrats on all the attention that your space is getting right now. Is the volatility in the bond market a continued signal that investors should be seeking safety in munis versus U.S. Treasuries?
And first, thank you again for having me on the show, Madison. I mean, municipals have really had a lot of underperformance versus other fixed income. Municipals are down about 2% on the year, while the Barclays Ag is up about 2%. So we're seeing this divergence in performance where municipals are underperforming by about 4% versus the Barclays Ag. Worst performing asset class here through the first quarter and actually on a year-to-date basis. So the message we're telling our investors is municipals are on sale right now. This type of underperformance our market sometimes gets from technical dislocations. But when you could start getting equity-like returns on a taxable equivalent basis, it usually is a very good signal for buying in our marketplace.
So what would you tell investors who have not previously invested in munis about the best opportunities for getting in, especially those who might be concerned about the discount they're getting given just all of the discounting that's already happening in their investment portfolios?
Yeah, I mean, I think relative to other fixed income asset classes, I would just say it's an asset class that has traditionally been very safe. These are essential service monopolies like a water and sewer credit, like paying your property taxes for a general obligation bond. So if you're willing to go in and to be on the safer side, right now on a tax-exempt basis, intermediate munis are yielding about 4.3%, which on a taxable equivalent basis, if you're in the highest bracket, it's about a 7%. And just looking back here over the last 10 years, that's in the 98th percentile for yield. So very much munis are on sale. And if you're willing to take a little bit more risk, high yield funds are offering yields in that, let's call it 5 3/4, which is an equivalent in the high 8s, low 9s. So, for the investor base that is wanting to get into fixed income, is concerned about tariffs, municipalities really don't have much impact from or are subjected to any of the tariffs. It's a great time to be investing, and given how much they've lagged here on a year-to-date basis, we think the entry point is a very attractive one.
And Dan, Steve Sosnick with Interactive Brokers is here on set with me, and he's got a question for you.
Hi, Dan. Pleasure meeting you. And as someone who owns a fair amount of municipal bonds in his portfolio, one of the things that I saw recently, I think it came out of JP Morgan, and it was questioning whether some of the new tax bills could impair the tax-exempt status of certain municipal bonds. The dire scenario would be as a whole, but that seems unlikely or unconstitutional perhaps. But in terms of certain revenue bonds, are you seeing those sort of dislocations cropping up in some of the pricing in some of the holdings within your funds?
Yeah, and be still my heart, Steve. Great to see that you have a good allocation of munis in your portfolio. Reading that same report and looking and speaking to our lobbyists on the Hill, there is a threat in the muni bond market of municipals on a prospective basis having some form of taxability. I think as well, there is some good news coming out, good news at least in that there's the proposal for a 40% tax bracket, which higher taxes, especially in the highest tax bracket, has traditionally been very positive for municipals. But, back to the prospect of a potential taxation on a going forward basis, we don't think it's probable, but if it were to happen, I think it would be in a more limited fashion. Those bonds that are financing private, if you look at private higher education, healthcare, stadium bonds, airports, these types of bonds that traditionally are deemed as private activity bonds have a potential on a going forward basis of becoming taxable, but we think that's an opportunity in that we think that those bonds would continue to be tax exempt and be grandfathered in and create a bit of a scarcity effect for those types of structures.
You brought up one of the points that I was going to ask was, how if the tax rates go up, this is good for munis, even if it is just at the highest end, because that creates more demand. But the other question I have here is with states and other municipalities facing federal government cutbacks, have you seen any qualms about the credit quality underlying some of these bonds?
Yeah, certainly. I think the thing we're most concerned with at the state level is a reduction in Medicaid funding. If you look at state budgets, their two biggest items are K through 12 education and their share of Medicaid funding. So if Medicaid funding gets cut, states have two pretty tough choices to make. You could go in and cut healthcare to the indigent, which is not a very popular path, certainly, or you could go in and absorb these costs yourself. I think the good news and what our analysts are looking at is that states still have rainy day funds that are equal to about 15% of their budget. These are at the highest levels that we've seen in the post-World War II era. So if there was an adjustment, if there was a cut to Medicaid, if there was less funding from the federal level, at least on a intermediate basis, we don't think this is going to meaningfully impact muni credit. But longer term, yes, for states, especially those states that are in that A3 type category, this could have a meaningful impact on their budget.
All right, Dan, great overview. We got to leave it there. Thanks for joining us, and thanks to our Steve Sosnick for the great questions to Dan as well.
Thanks.
Coming up, is an unsteady market making things risky for the wave of incoming retirees? We'll have that discussion next on Catalysts. With a record number of Americans turning 65 this year, our next guest says the latest market volatility could put those soon-to-be retirees' finances at risk and has some alternative ETF strategies that could be of use to those investors. I want to bring Matt Kaufman, Calamos Investments head of ETFs, for this week's ETF report brought to you by Invesco QQQ. Matt, great to have you on here. Just talk to me first about the activity that you are seeing from those soon-to-be retirees. How have they been positioning in this environment?
Sure. Thanks for having me on. I appreciate it. What we're seeing today is a lot of these retirees are largely invested in what we would call target date funds. As these retirees age, the traditional wisdom is to start moving from stocks into bonds. And, that economic uncertainty is really nothing new, but seeing people move into those bonds and have those bonds decline in value has not always been the precedent. So sometimes we see bonds providing that diversification that retirees are looking for. And other times those assets become highly correlated with equities and they fall together. And I think it's those times that we see that potential portfolio damage to retirees, especially those looking to use that portfolio to provide for themselves when they no longer work.
And talk to me about just some of the activity you've seen in terms of investors seeking safety in things like the equal-weighted S&P 500, but also in foreign markets like Europe, like China. To what extent have you seen that kind of flight to safety?
Yeah, sure. Financial crisis in general is nothing new. We've seen global financial crises. We've seen a pandemic. We've seen increased money supply, 500 basis point interest rate hikes. Today's catalyst seems to be this tension between a potential trade war, tariffs, while inflation hasn't really normalized to that 2% level that people are looking for. So we're up against this environment of the desire or even the need to bring inflation down against policies that are, theoretically inflationary, or at least on the short term. So people are wondering where to go with their money, especially retirees who have got to outpace that inflation over time. And so we're seeing those types of investors move into what we would call our protected equity solutions. So those that give you upside opportunity to allow you to stay in the equity markets, which, inflation tends to move through the equity markets over time, but then have a level of downside protection. So we have 100% downside protected ETFs for those who buy in toward the beginning. You can get that 100% protection. CPSP was our April S&P 500 series. That product launched April 1st. People who bought in on April 1st were protected from that drawdown in the equity markets. And we're seeing people move into those products even now to get that protection, but be able to outpace inflation with the market.
And Matt, I want to bring in Steve Sosnick of Interactive Brokers, our guest host. He's got a question for you.
Great.
So, hi Matt, looking through the holdings, let's say of the CPSP, it's basically, I'm seeing a very, 100 delta call struck at, Spiders struck at like 78 cents or something. Then I see a collar on top of it. And so now we're below the low end of the collar. When people were buying I understand the appeal now, because at this point the strike on the SPY is very much in the money. It's like 559 with the index at about 532 or something, the ETF at about 532. Do people, when people were buying in, I understand the appeal. Were they really understanding the idea of the collar, that you had your upside, that you did have your upside capped as a result of needing to finance the puts that you bought to protect their downside?
Yeah, oh, absolutely. And I'm glad you brought that up. One thing that we do in particular at Calamos is we offer all of that information on our website. So advisors and investors can go to our website, use the tools that we have, and they can see exactly what they're in for before they buy. You can see your upside opportunity, how much that upside is. There's no free lunch. There's a cap on your upside, how much protection you have. And then, to your point, how many days are left in that outcome period? So we see people buying in at the beginning. And then to your point on the optionality today, we see people buying in today after the market has dropped, because that ETF might be down 50 basis points or so. And so if you buy in today, you're going to earn that 50 basis points no matter what happens in the market over the remaining time frame.
All right, Matt, thank you so much. Really appreciate it. Still with me, Steve Sosnick of Interactive Brokers. Steve, we've got about 30 seconds left. You told me that for low-risk investors, no problem sitting in cash. What is the advice for the high-risk investor right now, or the idea?
You may not want to be, all in all the time with leverage, but I think you do want to be opportunistic. The key here is there are values to be had. The question is finding them, and the question is avoiding the minefields. And with something like Nvidia, which may have seemed like a good value on this pullback recently, now all of a sudden today looks very different. And this is the investing environment you're in. Be nimble. Look for opportunities. You can do it. If you're a long-term investor, stay the course. If you're 40 years out from retiring, 30 years out from retiring, just keep putting the money in your 401k. Let it work for you. If you do have shorter-term needs, then you want to be pulling in your horns a little bit.
All right, Steve, always great to have you. Thank you so much for joining me for the hour. I really appreciate it. Thank you so much.
My pleasure, Maddie.
Coming up, we've got Wealth dedicated to all of your personal finance needs. Brad Smith is going to have you for the next hour. Stay tuned.